Yes, so for about a week or two thereabouts, we've seen improved liquidity in the ironing window, and that has helped rates remain stable in that market. So we've seen rates in the FX markets in the ironing window remain at 363, 364 levels. And yes, we're seeing a bit of inflows to invest in the fixed income markets, basically.
All right, so we're seeing foreign investors getting invested a little more than, say, a month ago. Would you say there has been any change at all in terms of the level of interest?
Yes, so we've seen a bit of appreciation in that market because foreign investors have been bringing in some flows into the markets to invest in fixed income.
Right. So let's recap the level of liquidity we're seeing in the market. So this week we saw a very significant OMO auction by the central bank to try and mop up that excess liquidity. What can we expect going forward in your view? Going into next week, what type of liquidity can we anticipate?
Okay, so between November and December, we're seeing improved or increased volumes of maturity at the OMO window. So November, the total maturities for OMO is about 1.1 billion. Trillion, and then in December we're going to be seeing 2.2 trillion naira coming into the market. So we expect that the CBN would, mop this up aggressively through OMO auctions. Last week we saw them coming into the market twice in the week to mop up liquidity, and we expect, this going forward. But also we're seeing investors interested in the long end, that's the 364-day bills in the OMO market, and as we saw yesterday, a lot of volume was skewed to that particular tenor, and the central bank was able to mop up about 450 billion from the markets yesterday. So I do not think there would be a problem in them mopping up these volumes between November and December because the demand is there.
Right, but what can we read into that interest in the longer end of the T-bill market? Does that suggest that some investors think that we could see a decline in those rates later on and they are hoping to lock in for the longer term? Or what can we read into that in your view?
I think the majority of the interest is actually more local than foreign. So a lot of the demand is actually coming from local investors because at 14.5% on the discount rate, the effective yield is now at 17. So there's a lot of interest in that end of the curve to lock in at that level, yes.
Right. But what does all this mean for the bond market in terms of the level of interest there? So if you can get an effective yield of 17% in the T-bill market, what will be the incentive to get into the bond market? I know obviously there are those who are looking for duration, but overall, what do you think is the impact of the increased interest in those shorter dated T-bills compared to the bonds?
Okay, so for the bond market, the impact of OMO rates at 14.5 has been felt in that market for the past 1 month. So the market has been quiet, and also rates have been going up gradually in that market, and we would see more of this actually going to the end of the year. And this is because for us, we do not expect any major change in the indices at the MPC next week. However, if there is any change in this at the Monetary Policy Committee meeting next week, then we may see a bit of activity in the bond market. Also, like I said, in December we're going to be seeing maturities of about 2.2 trillion. So irrespective of the fact that more of the demand will be skewed to the treasury bills market, we would see a bit of that also going into the bond market. So there may be a bit of activity in the bond market, however minimal.
Right. Okay, let's focus a bit on the MPC meeting. You just mentioned that you're not expecting any major change in terms of the policy stance, but overall, over the last 2 months, what would you point to as perhaps the biggest considerations of the meeting? We know liquidity has been high, and we're going even further into an election season. Do you get a sense that the MPC may take some action, especially when you consider that there is now more and more support politically for an increase in the minimum wage, we could have some impact on liquidity as well?
Yes, the minimum wage has been a bit of concern, but also is the fact that so far we've not seen an agreement on that, and we may not see this even going into next year, them coming to an agreement on the new wage. So for us, we expect all of the indices to be kept, at these levels. Also, I think what they've tried to do before now is increasing the rate at the OMO window. I think this was done in anticipation of the liquidity increase that was going to come into the market, and it has worked because we've seen a lot of demand going into the OMO auctions, which has kept liquidity in the money market stable or to a low level, the same level it has been, before now. So
right.
I think to a large extent they've gotten the results that they wanted.
Okay, so
that's the CBN.
So the OMO auctions are working. Let's focus a bit on the Eurobond issuance, which many would suggest was very successful, given how the dynamics internationally have changed. We're now in a higher yield environment, and as someone mentioned yesterday, the era of borrowing at very low rates is perhaps over in the international markets, because that's always been the case for borrowing offshore, that the yields are lower. And I wanted to get your thoughts on what that issuance could mean for the issuance of local currency, treasury bills and bonds, as we expect that the government will continue to borrow in the local market. But could that issuance have any impact on the level of borrowing we could see locally?
So what we expect should happen is that because the issuance was successful, that's the Eurobond issuance was successful, is going to reduce the need to borrow locally. So our thinking is that this would also, should keep rates, stable, and we do not expect to see more of, or we do not expect to see fixed income rates going, further than these levels. We do not expect the CBN to increase rates in the local markets, because there is no need, for local currency borrowing.